Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss the overnight reversal effects in the high-yield market.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will once again discuss seasonal strategy. Just a reminder, the seasonal strategy is around 9% of our database, so we have around 90 of them. And I really recommend to read and view them because they are easy to execute and they can have an interesting performance. So the week before we discussed the lunge effect in US market indexes. So we discussed what is the impact of the lunge on intraday performance of the US market, and we also touched a little overnight effect. And we will continue this week, but we will discuss different asset class. We picked a high yield market. The fixed income market is especially interesting because it's not researched at the same amount as the US equities are researched. So it's little neglected. I must say that we also do not touch this market a lot, but we made a difference today. And we will go deep down into this interesting high yield market. What is the most important thing to understand about the high yield is that, especially high yield ETFs, they are very liquid instruments on illiquid market. So underlying high yield bonds are not very liquid, so it's not easy to buy and sell them, but the ETFs that are investing into these high yield bonds are very liquid, so it's very easy to buy and sell those ETFs. Once in a time it happens that there is a very bad mood or there is some volatility in the market, and once the people start to sell the ETFs, they can very strongly or very fast lose their value, but the underlying high yield bonds, they do not lose the value at all because they are illiquid. There can be very interesting reversal effects in the high yield bonds, especially in high yield ETFs, or I will show you how those reversals look like and how we can profit out of those reversals. So we will use the high yield ETF called HYG, which is Market iBox US High Yield Index Benchmark ETF. It has around more than 1,000 holdings and it's traded on your stock exchange. We downloaded those data. We had to do some calculation of the prices because we can get adjusted prices from finance.yahoo.com. For this ETF, we have adjusted prices for closes, but we need to adjust also the opening prices to study overnight anomalies or intraday anomalies. So we did some recalculation. Here is the first chart. So in the first chart, we can see what is the performance of the underlying ETF, the gray line, and then we can see what is the performance of the overnight session, which is the blue line, and what is the performance of intraday session, which is the orange one. As you can see, the buy and hold of the ETF gives us around 4.5% or something more than 4.5% performance over the year. The close to open session has more than 8% performance, and the open to close session has minus 3% performance. So there is significant spread between open to close and close to open, so between intraday session and overnight session. This spread is probably the highest spread that I was able to find in any ETF. So it's significantly higher than in case of SPI or in case of any equity ETF. And the reason why there is such big spread between overnight session and intraday session is especially connected to that effect that the high yield ETF is a very liquid instrument built on top of very illiquid bonds. So as we can see, we can have a high spread, but it's very impractical to trade every close and every open and every close and every open. If you would try to get this 8% performance on the overnight session, probably all the fees and the slippage will eat a significant part of the performance. We need to find some clever way how to profit from this anomaly, from this overnight anomaly, and do not trade so often. So what are our options? So first option is to try to run the seasonality test. So try to see if there are some days in a week that are more significant, in which this effect is more significant than in others. So here we have another 5 charts, and they show what is the performance of close to open session and open to close session every day. So here we have a Monday, here we have a Tuesday, Wednesday, Thursday and Friday, and you can see by yourself that there is significant seasonality. So the most significant spread is on the Monday and it's followed by the Tuesday, and as we are nearing the end of the week, So Wednesday, Thursday and Friday, the spread is significantly narrow. It's not so easy to profit out of the close to open and open to close spread. If I would choose, or if I could choose which days to trade, I would only trade the Mondays and Tuesdays. But we can even improve this simple seasonality. I mean, here is the table. So we can see that on the Monday, the overnight performance is over 3%. On a Tuesday, the overnight performance is over 2%, and Wednesday, Thursday, Friday, I mean, we are nearing 0. On Monday, the spread between nightly and daily session is the most apparent, so how we can even improve this anomaly. The next thing we tried is to compare what is the impact of the trend versus reversal. So what is the influence of the previous day, close to close, a session, on the nightly session of the next day afterward. Let us take a look on day-to-day results, again similar to the previous series of the charts, but right now we are just showing you what is the performance of the nightly session and what is the impact of the previous day trend versus reversal. So what is the impact if the previous day performance is positive, this is the trend, and if the previous day performance is negative, so we are trying to buy a reversal, we are trying to buy at the close of the Monday in case the previous day close to close performance is negative. So that's the reversal trade. Once again, we can see here is the picture of the performance from the Monday. Here is the Tuesday, Wednesday, Thursday and Friday. What we can say is that the most interesting performance is the Monday close. So when we have the negative performance from Friday to Monday close and we buy on the Monday close and we hold the high yield ETFs from Monday until Tuesday morning, we have very interesting performance with the small drawdowns or negligible drawdowns. It means that we will probably have interesting Sharpe ratio. So let's take a look on the table. So there is the final table. So we have performance over 2.6% with the 2.3% volatility, which gives us Sharpe ratio of 1.12. which is really great. For such a simple strategy, it's a very interesting Sharpe ratio. We have maximum drawdown minus 3%, which is, really minimal. The question is why there is such performance from Monday close until the Tuesday open. Some of you that know some patterns from US market, from US equities, they probably know this pattern. Yeah, it's the turnaround Tuesday. The turnaround Tuesday is a stock market trading strategy, and it leverages the observed anomaly where the price reversals frequently occur at the close of the Monday's trading session. The reason for that is that a lot of the time bad things happen over the weekend. A lot of the time when there is stress in the market, this stress culminates over the Friday before the weekend, because a lot of the people want to get out of the equities or out of the risky assets. So the Friday close is significantly, and then two things can happen. So the first thing is that Fed, or the people who are in charge, they can try to find some way out of the problem. They have a whole weekend for that. And in case they are able to find the way out of the problem, the Monday performance is positive. But in case the people in charge, so the Federal Exchange or government, etc., are not able to find the way out of the problem, the Monday close is even lower than the Friday close. That's the case of the Black Monday in 1987. That's the case what happened during the Lehman Brothers, etc., etc. So there are a lot of the significant events that happened in the past in which there was a stress on the Friday, and then the people in charge, they tried to fix the problem over the weekend. They were unsuccessful, and on the Monday, the close on the Monday was significantly lower than the close on the Friday. And that's the time when we should enter the market. There is less risk involved than buying the Friday close, so it's significantly better to buy the Monday close, because at that time, the liquidity nearly evaporates, and we are basically providing the liquidity for the sellers, and we are very nicely compensated by the reversal pattern from the Monday close until the Tuesday open. As we can see in high yield, because as I said before, that's the special instrument, or high yield ETFs are the special instrument, so they are very liquid instrument of very liquid market. This turnaround Tuesday is even better than try to trade it in the US equities. So I hope that you like this small effect with nice performance and nice return to risk ratios. And I hope that you will join me in the next video. In the meantime, do not forget to like our video, write the comment, or subscribe to our channel. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.